All right, hello everyone and welcome. My name is Peyton. I go by Pros11 online, and I've got the pleasure of hosting the MakerDAO quarterly strategic review call today. Luckily, I don't have to do the presenting. I'll just be calling on people asking questions and moving the slides. Thank you to everyone joining. We will have time for question and answers, so if anything does pop up on the screen you're wondering about, feel free to drop it in the chat. We can circle back to it at an appropriate time. Or just write it down and you can save it. Be more than happy to invite you on the mic to ask your questions. Quick housekeeping, this is obviously being recorded. We'd like to put this up on YouTube and save it for other people who weren't able to make this call. So let's try not to talk over one another and yeah, just generally be polite so the people of the internet don't think poorly of us. Awesome. So we have a number of people that are actually going to be doing the presenting today. Let me see if I can call them all out. I know we have Mark from Real World Finance. We've got Mark from Strategic Finance as well as Seb from Strategic Finance. Let's see, we've got Jan, TJ, and Nadia is giving presentation as well. I think that covers all of our speakers. You can correct me if I'm wrong, Mark.
Derek as well.
Derek as well, of course, sitting on my screen. Sorry, Derek. Well, now that I've bumbled your introductions, what better time to pass it over to Mark and let the professionals take over.
Awesome. Thanks, Peyton. Appreciate the introduction and welcome everyone. This is Mark, also known as AES or ACE on the MakerDAO forums. And welcome to MakerDAO's inaugural QSR meeting covering Q4 2021. Throughout today's call, we highly encourage participation. At any moment, just raise your hand and Peyton will help facilitate the question asking. We want this to be an interactive call and we want participation from people, because we're going to be going through a lot of data today. All right, thanks. Next slide, please. Brief legal disclaimer. This presentation is provided for informational purposes only, does not constitute financial, investment, legal, regulatory, or tax advice. If you're so inclined, you can read the rest, which we'll make available in a download of the presentation later. Next slide, please. So as the DAO's scaled up, we're starting to see some issues, particularly regarding community concerns around how effective core units have been in executing their mandates, and if the DAI spent on core units is driving value for maker holders. Our existing CE reporting is highly fragmented, lacks standardization, and is posted in different areas across the forums, making it difficult for maker holders to locate and assess how core units are doing. This is even more true for those who are new or spend less time on the forum than those on this call today. We also have no centrally agreed upon strategy or core mission, leading to a lack of focus, inefficient allocation of capital. The DAO has started to address this by signaling support for Rune's clean money vision, but we need to build a plan, align on strategic priorities, and allocate capital efficiently to achieve it. The motivation and purpose of these calls is to allow us to take a step back from our day-to-day operations and assess how the DAO is executing against our strategic focus areas and KPIs, align on priorities, and decide if adjustments are needed to our approach. The Web3 industry is rapidly evolving, and as a DAO, it's even more important for us to communicate effectively and ensure we're all aligned on objectives. Next slide, please. So as we've previously discussed and aligned on the forums, our current top 3 strategic focus areas today are number 1, ETH and WBTC lending, 2, scaling real-world asset collateral, and 3, increasing demand for DAI. Today, I think around 94% of our stability fees come from ETH, staked ETH, and wrapped Bitcoin collateral. This was even higher prior to the onboarding of the D3M with Aave. Both these markets have shown tremendous growth over the past year. ETH and WBTC lending has grown 29% and 110% respectively, as measured among the tier 1 DeFi protocols, which includes us, Aave, Compound, and Liquidity. When it comes to real-world assets, this focus area is important in a couple key ways. First, the total addressable market for RWAs is in the hundreds of trillions. Credit, equities, and real estate are collectively worth over 500 trillion alone. And these markets dwarf the total, crypto native markets, which are valued at around, 1.8 trillion today and dropping. So I think bridging into the real world assets is critical for having a long runway. Secondly, as the real world asset portion of the portfolio continues growing, the portfolio stability fees will be less correlated, resulting in more resilient stability fee income. Lower stability fee volatility will result in market participants, I think, valuing the Maker token much higher. This will also mitigate governance attack vectors. Increasing demand for DAI and expanding our presence on L2 is also extremely important. As the backbone of the DeFi stack, keeping DAI safe should be priority number one. The better DAI is as a product, the more organic demand there is, the more sticky DAI will be. Increases our chances, which will increase our chances of successfully growing the protocol. Next slide, please.
Yeah, so here are the main key performance indicators that we wanted to track as a MakerDAO as a whole. So it's subdivided in 3 categories. One, which are the lending metric, because obviously we are a lending protocol, so most of our revenues are coming from this line of product. The second one, which is key as well, are the DAI metrics, because we cannot lend if someone is not wanting to hold the DAI on the opposite. And the last one, which is super important as well, are the risk metrics, because we need to be sure that the system is safe, both for us and the maker holders in general, but mainly for DAI holders, because we give them the guarantee that DAI is always safe, which is super important. So first on the lending metrics, as you all know, the main 2 products we have is ETH lending and WAP Bitcoin lending. So we are tracking the market shares of those two markets. So we can see that it's not moving a lot quickly over time, but that's why it's always good to compare 1 year versus the previous one. So what we can say is that we are decreasing in ETH. Obviously, in 2021, there was a lot of new projects. Liquidity come in mind, but there are many others. So the market share or attention on ETH is more disparate. On the WAP Bitcoin, on the other hand, we are gaining a lot. We have gained a lot of market share over the year, from 15% to about half of the market. And just to go back on ETH, we are around half of the market, so we are kind of the leader in both ETH and WAP Bitcoin now. And on WAP Bitcoin, it was due to the acquisition of Celsius. On the real world asset outstanding, those are all the initiatives that is super important for MakerDAO of real world assets. That's growing steadily. There was nothing in the end of 2020. And now we are at the end of 2021, it was 17 million. Still not a lot, but it's growing. Net recurring income, so that's only taking in account the interest generated from the vaults and deducting the core unit expenses. We can see that we have a strong growth over time. Obviously, that fluctuates a lot depending on the interest rate we can charge, the stability fees, and the assets we have under management or at least borrowed on our platform. So that's why it's a big increase. Now it's a little bit less. There are fluctuation and there are trends that are taking a few months every time. The number of vaults, that is the rest of our customer base. You can see that we don't have a lot of vaults, or the difference between last year is a small decrease, still 40%. So we are not generated more users. The user base is more and more concentrated, and we can see as well in the new customer growth that it's going up a little bit on the last months of 21, but it's still very down compared to the previous year. This is obviously due to the gas cost on Ethereum and the increase of the dust. That was for the lending metrics. On the DAI metrics, so how can we be sure that a lot of people are holding DAI so we can lend those DAI in the market? The market share of a DAI is 5.8%. It's increasing over the year. It's a bit random, but still in a growth mode. So that's very good, because there was a lot of competitors coming into the market last year. But as you can see, we still gain market share. It was mainly due to USDT, that is still a big competitor, but is decreasing sensibly. And the second one, so market share is the amount of DAI, USDT, and so on. But what is important as well is DAI transaction market share. So tracking all the transactions that are on the blockchain, how much of those volume is on DAI? Because we have, if we have a high velocity stablecoin, that might be better than having a stablecoin that is not liquid on chain and that is just used on some centralized exchanges. So as you can see, there was a bit of spike. We will see it in a further slide in December, because it's always a bit messy on chain, but we are quite stable over the year, a bit above 10%. And now I will lead the risk metric to Jan, if you want to.
Thank you, Seb. Hey, everyone. So given that capital risk involves quite some context behind it, it also makes sense for me to just take a minute to explain the logic and how it works. So first of all, like I want to just answer the question of what is capital risk. And the simplest version is that it actually quantifies the estimated loss that Maker could experience within 1 year, given a certain financial risk profile, right? In very short form, that's essentially just annualized income if stability fees are equal to the risk premiums, which are the output of the collateral risk model, right? So that's basically the first one. Then is how we estimate it. It's related to, again, the collateral risk model. And what we do is that we run the simulation model across all the vault types. Then we compute the risk premium, and then we multiply the risk premium with the debt exposure, and that's basically capital risk per vault type. And when we aggregate all the vault types together, that's portfolio level capital risk, right? So the third question is why it matters, and the main reason is to size up the necessary surplus buffer for the financial risk of the portfolio, right? And to basically make it more concrete, let's say, whereas financial risk coming from, let's say, increased debt exposure can be instant, income coming from stability fees is accruing continuously, let's say, with a 1 year lag. And we could see already from the past, let's say, in the last couple of months, like how month over month, basically loan revenue can be very volatile. And let's say if we have a steep increase in the financial risk, and we don't have that revenue in the balance sheet yet, that can basically provide like a problem for us, right? If in the case of a price shock. And then the third thing is what are the different factors that have an impact on it, and the three main ones, apart from the total debt, like basically like the AUM, are the CR distribution. Here we are just using the if only collateral vault types as a proxy, and then we have the liquidity. Liquidity is, yeah, the CR distribution is quite simple, I guess, to understand. Then we have the liquidity, which is where it's a function of two things, which is the debt exposure of all the if only collateralized vault types. That means if A, if B, if C. And then if we solve that off, then we look on the slippage curve and how much of that amount would actually be captured. That means that, let's say in December 21, that's 25%. That means 75% slippage, 25% would be actually captured, right? And then the last one, which is actually a separate model, and it's an input into the collateral risk model, is the share of votes protected. And that's basically estimating how much of the vaults would actually be liquidated given the historical data and also, let's say, the present state. Let's say a high CR of a vault, let's say 400%, that indicates that there will need to be a significant drop for that vault to be liquidated and for us to incur losses from it, right? That's it from my side. But apart from that, the metric, it's that the capital risk has decreased by 1/3, let's say, in Q4, and that's partially also reason because we were still tweaking a bit the vote protection score, which is underlying the share of votes protected, and that's altogether contributes to the whole portfolio level metric, right? And but I can basically go into that a bit later.
Thanks. Next slide. Okay, this slide represents the summary of the financials. So this is what you see already in another presentation from Strategic Finance every month. But here is you have zooming out a little bit and see the quarter over quarter and year over year. What is interesting is always to focus first on the net interest income. Just to reframe it, it's what we get from lending the DAI minus the DSR. So the DAI saving rate that we are offering to the some DAI holders, which is currently 1 basis point, so it's almost insignificant, but it could increase in the future. That's really a financial metric that is kind of recurring. It's not so much recurring because the yield on DeFi are what they are, so they are moving a lot all over the place, but things are stabilizing over the years, and we should expect that it will be more recurring over time. On the other lines, you have the net trading income, which was a PSM, and the stablecoin vaults, which are no longer used really. So in 2020, it was mainly the stablecoin vaults because we had a big issue. So we made quite some profit from that, but it was for the wrong reason. And in 2021, it was mainly the PSM. So that was 4 million, but it's unlikely to come back this year, for instance. But it's not a big deal because it's not a product line that we are working a lot on. And the next line is a net liquidation income. You will see that's something that is quite significant if you see overall. It's always in 2020 and 2021, it's around 10%, or between 10 and 20% of the revenues, which is quite significant for something that we hope would never happen because we don't like to take, that means that we are losing some customers because they are liquidated, and more often so liquidated customers are not coming back. So we will lose interest income over time. The bad debt expense was a big hit in 2020. It's when we have some bad debt and backed debt. But in 2021, there was no issue on that front. So then you have the net protocol revenues that you can deduct the workforce expenses, which are mainly the core units, or only the core units, which gives you the net protocol income, which is still increasing a lot, even if workforce have only started in 2021. The net protocol income increased way faster than that. And we just give, just below that, the recurring income, which is just the net interest income minus the workforce expense, which is what we can expect to get months over months, and that is more stable over time. And you have the maker price, which is obviously quite important for maker holders. And sometimes it moves with the recurring income, sometimes not. Just to recap on the 2021 milestones. So on a financial perspective, everything is quite good. All numbers are up. On the risk side, everything is better as well in terms of surplus buffer protecting the protocol. It's still super low, but it's better than what we had 1 year ago. MakerDAO Foundation announced its dissolution and returned almost 10% of Maker token to the DAO. So that means that there was a relative effect for every Maker token holders, because now you add 1 Maker, but now your impact is almost 1 Maker. Real World Finance was the first core unit created, and now we are up now to 18 core units. And remember that was end of 2021, and we have now more than that. Major launches in the product line was Real World Asset Collateral Onboarding, the Aave Direct Deposit Module, D3M, the new liquidation system, Liquidation 2.0, as a flash minting where you can borrow almost as much as you want DAI for just 1 block, and the vote delegation that improve sensibly the governance of MakerDAO. And one last item is that Ruin publishes the case for clean money vision that was accepted by MakerDAO. That means that MakerDAO is now trying to have an ESG framework. And that's for this slide. We can move for the next slide, please.
Thanks, Eb. We've put together a high-level revenue and expense forecast for 2022 using a top-down methodology. The key assumptions in this forecast are that we maintain market share in all collaterals, and we have no changes in collateral prices or stability fee rates. With that said, we expect the ETH lending market to grow by about 23%, wrap Bitcoin to grow by about 55%, and non-ETH WBTC markets to grow by about 23% as well. We're also forecasting to have about 300 million in DAI onboarded through RWAs by year end, and around 700 million USDC earning 50 basis points as we start to invest the protocol's stablecoin reserves. We've also conservatively forecasted 1 million a month in liquidation revenue for the remainder of the year. Adding all of this up, and our full year revenue run rate exiting 2022 will be around 170 million. So the ETH lending dynamics may change significantly. As we all know, the merge is coming up and staking will become much more accessible. We may quickly see liquid staked ETH become the dominant collateral type. We'll have to keep an eye on any emerging liquid staked ETH tokens. Assuming all the current core unit budget increases pass, our full year 2022 expenses will increase by 39% relative to the Q4 burn rate. On a year-over-year basis, looking at Q4 2022 versus Q4 21, the expenses would increase by 72%. If prior budgets are maintained, our expenses will increase from the Q4 annualized run rate by about 22%. Keep in mind that Oracle prices will be a very large variable in our year-over-year expense growth. We've used the January run rate for the full year, which is down about 26% Q4 actuals. But they've been quite volatile over the last several months. Most recently, the Oracle expenses have continued to decline for the last few weeks, especially as the NFT hype has started to cool down a bit. So, if the current last few week run rates continues, we'd be paying for about 150K a month in ETH costs if the price of ETH and GWEI is maintained. Next slide, please. Back over to you on.
Thanks, Mark. So to continue the discussion on the capital at risk, as it relates to surplus buffer, it makes sense to also put it in relative terms. And we can see that in Q4, capital at risk has been significantly higher than the surplus buffer, which basically has, obviously had been rising steadily. Whereas capital risk is much more volatile, right? So even though the capital risk has fallen since then, it definitely makes sense for us to protect ourselves against, let's say, a potential market pump and let's say a drop and so on. So and for this reason, we think that it makes sense to build a proper surplus buffer of 150 million, which is the average of the capital at risk in Q4, and to have a good, let's say, a risk mitigation strategy in case, let's say, we have certain unexpected price shocks. So that's number one. And number two is that also the capital at risk as a percentage of risk debt, which is also something that hasn't changed that much in Q4. That's why we also are looking at capital at risk, which is a much more is more indicative of putting it in relative terms compared to the surplus buffer. Next slide, please. So once again, if we go into a deeper view of the capital at risk, and we see that the capital at risk has decreased in Q4 going from 141 million in October 2021 to 102 million in December 2021. We could also see in the table above in the risk KPIs that both the CR distribution has decreased, basically increased, which means that the capital risk should basically go down. That has an inverse relationship, and also the liquidity has an inverse relationship, and also the basically the third factor, right? So the other thing is the shareholders protected, which is the thing that has the largest impact on the capital risk, and we can see how that has increased since October till December, right? We can see that how that the simulated votes that were basically liquidated, right, in our simulations went down, and that also contributed to a decrease in the capital risk. So the main explanation for a decrease in the capital risk during this period is basically the shareholders protected parameter, which I went into a bit before. But otherwise, if you're interested in reading more about the methodology, we also posted an article on Medium, and we are very happy for any further questions. Yeah. Next slide, please.
So I want to give you an overview of what's happening on the supply and demand of DAI. We have seen how large bolts have increased thanks to Nexo and Celsius and other whales that we have with who we have been discussing about institutional bolts. And this is quite interesting because it has made us think about, because I don't know if you all are aware that institutional bolts, although we are talking about the product, it hasn't been deployed yet. The poll passed, but we are waiting for some minor details so we can launch the executive vote. So although it haven't passed, it has been a good excuse to have this one-to-one conversation with the whales. And one thing that we learned about this is that, of course, they are super interested in having a fixed stability fee, because they think that Maker with the over collateralization ratio is not that capital efficient. But we think that they also care about this one-to-one support. So that is important for these institutions, and it's something to understand if we want to grow in that aspect. We have seen, actually, you can see that when we started talking with Nexo about it, it was around September, October, and then we have the same conversation with Celsius, and you can see how the largest bolts increased in number. So also what Seb said at the beginning, Celsius, when we mentioned to them that the minimum to have access to the institutional bolt was 200 million DAI, was to mint 200 million DAI, then that was interesting for them, and that is why they started using WBTC Vault. Another thing that we are also seeing is how the ETH market is a super competitive market. There are a lot of players around, and that is why we have to be careful about it, because of course we try to have always the best rates on the market, but it's hard to be the number ones, and I think that is the reason why we have seen how we have been losing a little bit of market share compared to the previous year. So that is why it's super important for us to be more focused on the stake it, raising the debt ceiling, and also the onboarding of the stake it LP token uncured, because that will help us to attract all these users that are looking for better alternatives than just having ETH, which is a stake it or similar tokens. GUnit is the most effective way to increase DAI liquidity with stablecoin pairs. And it's also a huge success for the protocol. Actually, it's also one of the most important collaterals that we have right now with Ether and WBTC. And that is why with our challenge about increasing liquidity on layer 2s, GUnit, once we have MakerVaults deployed on these other domains, GUnit could be the right tool to increase DAI liquidity on these other domains. And one thing that now that I'm talking about other domains and layer 2, one of the important things that you can see on these charts is that although we have a 15K dust parameter, the 70% of the vaults that are on Maker are minting less than 100K DAI. That is retail. So we can see how important is MakerVaults for retail. The problem is that with gas fees and with the dust parameter, we are not giving the right solution for these people and this market that is unattended. So that is why, and I know we all know that, but this is like a fact that shows why we need to prioritize and launch as soon as possible MakerVaults on layer 2s. And I will say not just layer 2s, but also in any domain that is attractive to retail. Next slide, please. So that was on the supply side. Now talking about demand. In terms of liquidity, as someone mentioned before, USDT is the main stable coin in general, but that is especially on centralized exchanges. And I think it doesn't make sense to compete against USDT in that field, but layer 2s should be or space to compete. And in there, we are not the main stable coin used, that is for USDC. So USDC is the main stable coin in DEXs. Like if you check any main DEX on different layer 2s or side chains, USDC pairs are the most liquid ones. And BUSD, it is important and is the main one, but in Binance Smart Chain. So I don't think that that's also something that we should care about. I think our main challenge here is how we are going to win against USDC on layer 2. And again, I don't think centralized exchanges have to be the place where we want to be the leaders, but layer 2 should be, mostly because that's the place where we are putting our efforts and try to build the MakerVaults. So it is also a priority to try to find a solution on how we are going to improve DAI liquidity. Just to give you an example, at the moment when I wrote this, USDC supply in Arbitrum was about 500 million and DAI supply was about 43 million. It's an important problem because even if we decide to deploy DAI on Arbitrum, we don't have 500 million in our surplus buffer to deploy there. And of course, we can wait until the MakerVaults are there, but what will happen until we deploy it? So those are things that we have to prioritize. And the liquidity question is something that we have been talking in the different working sessions we have with other core units, but we have to focus more on that because that has to be priority for us. Also, in terms of liquidity, it is quite interesting to see how DAI is not a leader, not in Arbitrum, Optimism, or layer 2s in general, but DAI liquidity is huge in Avalanche and Phantom and Polygon sidechains. You may ask why, and we think one of the most important magnets of liquidity are rewards or farming. So when we think about strategies to increase liquidity, we should think about this kind of resources. Like until now, we haven't done anything to improve DAI liquidity, but we have to pay attention, because when there's not DAI liquidity in one of these domains, new projects decide to integrate with USDC, and that increases USDC liquidity, and that makes us less relevant in the space. So that is something that we have to solve as soon as possible. Next slide, please. So what's ahead of us? On the supply side, we want to launch institutional vaults as soon as possible, because we have seen how attractive it is this product for institutions. And for us, it's super interesting to have a product for institutions, but in a permissionless way. We haven't launched like a different Maker protocol to attend to these customers, which I think is great. And also it is an excellent tool to increase DAI supply with our main collaterals that are ETH and WBTC. And also we have to pay attention to retail, because we are losing that market. We have to prioritize the deployment of Maker vaults. And this is something that I've been seeing, I think not just in layer 2s, but in different side chains, like side chains like Polygon, where the POC DAI is huge. It's an interesting market for us. And these side chains are also interesting in having Maker there. So we could like make agreements with them and have a benefit for both sides. Like I have been talking with Polygon and other side chains, and they want to help us to launch these Maker vaults in their networks. Even like they are considering giving rewards in their token to increase DAI usage there. The challenges we are seeing, well, with institutional vaults is that the DAI supply is super concentrated in these whales, which represent a huge risk for the protocol in case of liquidations. What we are doing to try to avoid this is protocol engineering is suggesting to these institutions the audit of the code that they will use to protect their positions. And in the case of deploying Maker vaults in other domains, and I think this is also a question I have about the surplus buffer. How are we going to manage to have higher debt ceilings in other domains with the surplus buffer that we have now? So that is a question for all of us. I think we all agree that the surplus buffer it doesn't represent the size of Maker, but that's not just the only problem that I see. The problem that I see is when we have the intentions to expand our business, adding more real-world assets as collaterals to the protocol, or deploying liquidity in other domains, or having higher debt ceilings in other domains, we need a higher surplus buffer to support us in these growth initiatives. On the demand side, we are seeing a lot of interest about how to migrate liquidity from mainnet to other networks. So maybe once a wormhole is launched, we can work on that message and convert wormhole also in a product of Maker to solve this opportunity that we identified in the market. And the challenges we have on the demand side is, well, first, DAI liquidity. I already have mentioned this challenge we have a lot of times. And the other one is if we are going to have presence of the canonical DAI on different domains, we will have the problem of liquidity fragmentation. And again, probably we can solve that with a higher surplus buffer, having good alternatives on how we can increase DAI liquidity in those domains through rewards, or different strategies to increase the liquidity and have a stronger presence in those domains. Next slide.
Thanks, Nadia. So another one of our strategic focus areas is the ETH lending market. Understanding this market and how it's kind of evolving over time is very important. And given the volatility of crypto collaterals in fiat terms, assessing the market share in crypto native assets is much more reflective of true market trends. So this data set measures the ETH lending market on layer 1 amongst tier 1 DeFi protocols. As you can see from the data, ETH supply grew 3.5% last year, and the ETH lending market grew 29%. And while Maker was roughly flat until ETH deposited, our market share decreased by 14%, with Aave and Liquidity being the primary beneficiaries. Our market share bottomed in early Q4 at around 33% and has since rebounded to 48% by year end, taking share back from Aave and Compound. So we're trending 100% in the right direction here. And the next step in this analysis is kind of to dive deeper into the market's growth and fluctuations in our market share. I think Nadia and team have already started this analysis, and we're going deeper on the data side to look more into customer segmentation and the overall broader market of customers. Next slide, please. Back one. Yeah, thanks. The WBTC lending market grew tremendously last year. This was something that was surprising to me when I first looked at this data, but it more than doubled in supply from 2020. So we went from 117K wrap BTCs to almost 268K. And unsurprisingly, much of that wrap Bitcoin made its way into these tier 1 lending DeFi protocols. Of that growth, Maker captured about 76% of the 110% market growth, tripling our market share and nearly 7xing on an absolute basis. So huge growth for the Maker protocol. We took considerable market share from both Aave and Compound, driven by the significant inroads made in Q4. The stability fees earned from WBTC as a portion of our lending portfolio have also continued to increase into Q1, and actually look to be on pace to surpass ETH in the future. Next slide, please.
Thanks. I will present the DAI on L1 market share. It's just different data linked to the KPI I had a few slides earlier. So as you can see, the market share of DAI is roughly around 4%. It's increasing over time. What is interesting are the dynamics in the market. So as you can see, BUSD grew and is now over DAI, but that could be mainly due to the fact that USDT and BUSD are used mainly on centralized exchanges, and obviously Binance is pushing for BUSD. So that's why we have this migration. It wasn't a market that we could get anyway. So it's more migration from USDT to BUSD. We have UST, so Terra, coming big on L1 as well. Obviously, when you propose 18% APY on stablecoin deposits, you get a lot of traction. Let's hope it will not continue forever. But what is super important is really, and the big shift is really on USDC, which it doesn't look like so big, but it's gained a good part of the market share and eating USDT. But what is interesting is if you looked at other metrics, on-chain metrics like trading on decentralized exchanges, we were the number one by far early in 2020, sorry. But now we are quite far, and that's a liquidity issue that Nadia is super right to push forward to the community, because liquidity is super important to be as number one. And even on the lending platforms, again, DAI, obviously we are lending DAI on MakerDAO, but we are also lending DAI of people are lending DAI on Aave and Compound. It was mainly DAI that was lent on DeFi, but now it's going towards more USDC. And it's only because we are DAI that we can still be the king on this front, but it's difficult to be, we are challenged still. And on the stablecoin on-chain volume, well, things are more flat, but it reflects almost the same thing. It's moving towards USDC that is more and more used. And it's even bigger for USDC compared to USDT on the on-chain volume, because really USDC is becoming one of the key currency in DeFi, which is, I would say, our main competitor on that front. So there is a lot of work to be done, liquidity, other ideas, everything is possible, maybe raising our DSR as well. But for that, we need to be able to invest all those capital we have on the balance sheet. And so we need to find a solution on the long term. It's not a big risk currently, but it's something I think we should think about it. And if we can go to the next slide, please. This is a good example because last year was the first year of layer 2s. And what we can see is that on the two main ones, which are Arbitrum and Optimism. So while we had a good start on Optimism, now we are losing market share. I didn't check, most likely Liquidity made a liquidity farming incentive or something like that to gain so much market share. But still, we are losing market share against USDC and USDT, which is not great. And the situation is even worse on Arbitrum, where we are not relevant at all. I would say there is no other way to put it. It's mainly a world driven by USDC and UST. And that might be explained because we are a bit late to the party, because we have a better bridge than the other. But we didn't catch up because, in part, because we weren't put into the pool 2 of Curve in Arbitrum. So as you know, the pre-pool on Curve is super important on L1, because we have 2 billion of DAI in this pool alone, and we are not present in the main Curve pool on layer 2. What else did we say? Yes, that's about it. So it's super important that we focus a lot on the ZK rollups, Starknet, ZK-Think, and the others, to be really the best one and take a foot in those L2 before the other can come. And that's for this slide. Next slide, please.
Thanks, Seb. TJ with Real World Finance. So really the last 6 months of Real World Finance have been laser focused on the professionalization of collateral onboarding. That's really consists of 2 components. The first is laying the infrastructure, really laying out the pipes for responsible scaling of DAI in the real world. And the second piece is sort of eliminating the chaff and onboarding the wheat. So onboarding high quality assets with high quality counterparties. First piece, the infrastructure is really embodied kind of by the methodology for structured finance that was posted on the forum by my team core contributor, Eric Rapp, really lays out a philosophy for more investment grade type assets. Investment grade does not really refer to a category, it more refers to underlying principles that protect Maker token holders from losses. The second piece here is really focusing on a more qualified or structured MIP6. This sort of puts some onus, some structuring onus, as well as some thinking around commercial risk, and legal structure on the counterparties, really sort of ups the quality of the propositions of the MIP6s. The third piece is really ensuring that MakerDAO has the necessary covenants, rights, and remedies in the real world. So should something go wrong, the Maker token holders have the ability to salvage value in the real world. As people well know, it's not as simple as liquidating a vault and making that vault whole. The real world is messy across different geographies, different legal structures, etc. So we don't want to make any compromises in the real world relative to sort of other similar institutions making loans on things like real estate and renewable energy projects. And the last piece on sort of that note is updating, upgrading the legal structure that MakerDAO has access to, and adding external legal support as needed. RWAs are heterogeneous, non-standardized in type and in different geographies. And so we want to reflect that in our structure. The second piece is really the culling of the chaff and the onboarding of wheat. Historically, MakerDAO may have been sort of exposed to an adverse selection issue whereby either unqualified or simply, alternative and creative, shall we say, counterparties approach the protocol, knowing that on the open market, they'd probably be unable to access traditional financing. And they see that MakerDAO has a competitive cost of capital and potentially a little bit more creativity and entrepreneurialism. We want to make sure we focus on just the best of that group and avoid this adverse selection issue. I think this sort of mission can be embodied by the onboarding of SocGen of a bunch of French covered RMBSs as of recently. Another initiative we're really excited about moving forward is a separately managed account with short-term money market assets. This will give MakerDAO an opportunity to establish with to partner with an established partner in traditional finance. This has sort of 3 points. One is to reduce the protocol's reliance on USDC and a single entity. The second is to achieve a little yield for the Maker token holders. And the third is to respect and facilitate the liquidity needs of the protocol. We're particularly excited about this one. It'll represent the first major collaboration between strategic finance and real world finance. The goal here is for MakerDAO to compete on a level playing field outside the confines of DeFi. And that's really embodied in the pipeline you see to the bottom left. All of these opportunities represent between $20 million and $1 billion deals with often world-renowned, recognized, and regulated institutions. Those deals represent a potential total volume of about $1.5 billion in real-world asset exposure. That's the end of the slide.
All right, hello everyone, Derek here from Protocol Engineering. What we thought we'd do is give you a quick summary of some of the technical tasks that have been accomplished that have been driving much of the financial discussion that we've previously had. So first of all, jumping in, the onboarding of Aave D3M. This has been really successful to date. It's generated, I think, $167 million worth of DAI. Similarly, the onboarding of collateral, including State ETH, GUNI, WBTC B and C, is to date generated, I think, close to $500 million worth of DAI, like Mark was walking through earlier. So really good progress in those collateral types. We've also been working a lot on the Maker wormhole. So to Nadia's point around making sure we have a presence in the L2 space, making sure that we're able to access liquidity across chains and have mechanisms in place to do so has been a big focus point and something that we're working on. We've also made some internal improvements to optimize awareness across core units. So making sure that we optimize our working patterns with collateral engineering services, for example, making sure that we're able to scale our ability to onboard new collateral and have those frameworks in place to do so, which has been great to see. They've been stepping up and playing a role in onboarding collateral with some initial oversight from us. But again, the goal here is to have multiple teams being able to focus on smart contract work, collateral onboarding, and to enable MakerDAO to scale. The future work that we will be are undertaking at the moment for Q1, again, is heavily focused on Optimism, Arbitrum. We're also working closely with the Starkware team, and we're also having discussions with other ZK rollups like ZK Sync and Aztec as they launch their test nets, and we get involved in those ecosystems as well. Also having a focus on Curve LP, Oracle, crop join tokens. So these are tokens that enable rewards to be generated and earned as part of collaterals that are deposited in Maker. We are also working on a rate limited flapper, although this isn't as strictly necessary as we've this week increased the surplus buffer vote. I think it's been increased to about 250 million, but it's good to have it in the back pocket just in case it's needed. And we've also been heavily involved in the institutional vault work as well, which is a DSS charter. So that's supporting the work of Nexo and the discussion that Nadia mentioned with regards to Celsius and others. So again, focus on scalability, making sure that we have these technical mechanisms in place to scale for other third parties. And this is very much reflective of the work that we're doing around the D3M. So making sure that we're able to scale the original solution of the Aave D3M to Compound and others. So there's a lot of modular work happening there so that we can decouple the internal maker side with third parties and have other teams such as CES and ourselves, of course, work with other third parties and scale that offering. And that also extends to other third parties like Maple Finance, and there's a few other fixed rate initiatives that we're working with as well. Another team is Deco, and they've got an offering, and this very much plays into the DSS Gate initiative, which will enable us to create sandboxes and create debt ceiling limits to risk limit initial opportunities and enable us to, again, scale. It's something I've reiterated a couple of times, but it very much plays into this opportunity for us to target very disparate, diverse areas of growth. And wrapping up here finally with the MCD on Optimism and Arbitrum, doing a lot of work in this space. So there's a lot of research and development, making sure that we can copy over the MCD on layer 1 into L2 and then understand how the system behaves, how we're able to support native L2 tokens and grow these different ecosystems and different domains, and understand how we're able to focus on the different liquidity areas that exist within them. So a lot of work happening there, and really looking forward to getting into this and taking it forward. So thank you everyone for all the work.
Thanks, Derek. So we also put together a short list of some other areas that we'd like to kind of discuss as a community. I think importantly, there should be governance and community metrics of some sort to kind of assess how we're growing the community and how efficiently governance is being handled. I think more broad objective setting around some like quantitative stuff would also be helpful, and more DAI metrics we're considering building and looking into, like things that measure the usefulness of DAI. So like peg stability, amount of like integrations we have, whether that's DeFi protocols, CeFi exchanges, etc., number of unique holders, and a bunch of other topics. But yeah, I think at this time we'd like to open the floor for any Q&A for any of our hosts. Thanks, guys.
Hey guys, for that presentation. Go for it, Frank. Sorry, man. Geez, didn't want to forget this question, but with regards to, I guess, this would be a good question for Peku. I don't mean to pick on you, but I saw the last slide there. You mentioned that you're looking to release MCD on Arbitrum and Optimism, which haven't been the most popular layer 2s in the world. I'll admit that, being a user. How are you thinking about MCD on layer 1s or side chains? And since Nadia mentioned that yield farming is one of the most attractive tools to get DAI liquidity out there, why wouldn't we look at releasing MCD on something like Polygon, where people can farm Matic, the token? So I'm talking about cutting a deal with Polygon where you are essentially doing MCD and getting Matic as a reward. Hopefully that makes sense.
Yeah, definitely that makes sense. And yeah, I know that the members of our team and growth team have been looking at the opportunities for getting onto Polygon. And I think it's absolutely a contender for focus. That's one of the main drivers for us having recently created internally our own work streams that focus on, cross-chain scaling, cross-domain scaling specifically, because it's not just relevant, the work we're doing for L2s, it's also giving us an opportunity to look in other areas and also work with the liquidity generating yield farming opportunities that exist in those chains. And like Nadia said, we've got to look to where retail is participating and where those liquidity areas are growing. So definitely we're not wedded to any one particular L2 or sidechain, and Polygon is definitely a contender that we're looking at. Now, how that would work from a technical perspective, I think there's some risk discussions we have to have there. How are we going to, what sort of debt ceilings are we going to have in place? How do we participate? How do we have agreements with the side chains to scale effectively and have an eye on what does that risk look like for both parties involved? But I mean, long story short, I think, yes, definitely we are looking at that. We do want to scale into that space. We do want to understand the technical solutions that we'll need to integrate. So definitely keen on expanding into that. And I think that's the basis for some of the discussions we're going to have with growth coming up as we understand how to break down MCD into different domains.
Got it. And a follow-up question for Nadia. You mentioned that retail is key, which I agree with you. I think that there's one thing that I'm hearing a lot is that 5 years from now, RWAs are going to be maybe 70–80% of DAI supply. And then the rest will be obviously the crypto part of it. But I think that we're forgetting retail. And I was just wondering with regards to expanding into something like Starknet and other layer 2s and maybe side chains in the near future. Are you guys in growth looking at maybe integrating with some kind of wallet provider where the average human being can interact with DAI? So just wondering what the thinking is there behind the growth team and getting retail going.
Yes, of course. Like I think we are the ones that are constantly trying to convince Bartek to include Polygon and other side chains to the multi-chain strategy. So yes, like we think it's super important for the protocol. Still, I think that like 80% of DAI supply will come from real world assets. I don't think this is an effort for increased DAI supply. I think this is an effort to maintain DAI relevant. So it is a feature that retail is looking for, and we can see it on like the amount of vaults opened for less than 100K DAI. So there's market for it. Problem is that right now, for us in growth to talk with a wallet, to integrate Maker vaults, it doesn't make any sense because no one will use it. Like it will be crazy to open a vault using a wallet. But once Maker vaults are implemented on layer 2s or other domains, that is the first thing that we want to do. And we already thought about how to talk with retail about this opportunity, because it's a way that people will be able to be the owners of their loans, which is incredible. It is like unique. So we're waiting. It's like more like a technical challenge right now, but I think the market is ready. And we already know what are the wallets that want to do that integration. And we're just waiting for having Maker vaults on layer 2s and have a lower dust, because that is a must to integrate Maker vaults in these wallets. And for having a friendly user experience for newcomers with DAI, yes, of course, we have been doing that since moment one. Unfortunately, that is almost impossible on DeFi wallets. Because again, gas fees and and on-off ramps and all of that. So that is why these efforts are around CeFi, around centralized wallets, because I mean, a newcomer, if he wants to buy DAI, he wants to use MoonPay with his credit card, he has to use an exchange to like pay it with fiat. Like that is is like that. Like it can be do somehow else. Of course, you can convert another crypto into DAI and use a Rainbow wallet, but still it's not enough. So yes, definitely that's priority one, to work with wallets and have better interfaces, but we have to be conscious as well about the reality of the DeFi space. Like DeFi is not yet prepared to receive someone who doesn't know anything about crypto. The ones who are ready are CeFi companies, and we are working with them.
Yeah, and one thing I want to add about the getting MCD deployed on all these EVM compatible chains, the longest amount of time is going to be the first deployment. Once we have the first deployment, all these change, they're EVM compatible. So it's not, I wouldn't call it easy, but it's going to be way quicker to replicate this on things like Polygon. And for the record, I do think we should deploy on Polygon with reasonable debt ceilings.
Got it. And I guess the reason why I was asking about the retail side of things and having a user-friendly wallet was because I look at the competitors, right? Maybe not competitors, but other chains that are not EVM compatible. And obviously that's Solana. Solana's main goal is to do two things. One, institutional high frequency traders. And the second one is to be the first app to have 100 million users, right? Because they believe the one who has the most users is the one that wins. And then you look at Terra Luna UST, and I had a great pleasure of hanging out with Du, who's from Korea, and he showed me the Terra Luna app, and it's so gamified. It's so like I could see why it's addicting and why it's successful in Korea. So I was just thinking, you know, is that something that MakerDAO should consider? I mean, how important is the retail, the individual human being in using DAI? But yeah, thanks for the answers. That's enough for me. I don't want to take up the time anymore.
Thanks, Frank. And yeah, I encourage anyone, if you have questions, you can either ask them on the mic or drop them in the chat. We're happy to ask them for you. In the meantime, while everyone's thinking of theirs, I don't know who would be ideal to answer this, but you were the one who said the statement, Mark, so might start with you. Was curious about the WBTC scaling. Obviously, this year we had WTC B and C, as well as lowering the liquidation ratio for WTCA. So I assume those are kind of driving factors and ones that we probably can't repeat again to as much success. So I was wondering if you could walk us through like what will be the driving force between more WBTC usage for DAI supply.
Yeah, and I'll give a brief intro, and I think Nadia is extremely well educated on the subject as well. But we're seeing, I think, a lot of institutional interest from people that and institutions that own WBTC. So I think in Q4 specifically, you know, Celsius came on board, but we're also, you know, having conversations with other institutions that have a lot of Bitcoin. And I think as institutions get more comfortable wrapping their Bitcoin, you know, there's the potential for this to surpass, and ETH is our #1 like crypto native collateral. You know, I think we should start shilling Michael Saylor a little bit and try and get him involved. But so far he's been resistant to ETH and DeFi, so it might be a little far away on that one. But I don't know, Nadia, anything you want to add? Any color?
Yeah, I think institutions, their treasuries are full of Bitcoin. That's why if we talk about institutional vaults, they will open a vault with WBTC, and DeFi projects like the old ones have their own token or ETH. So yeah, that is why, like the reason why we have all of this demand of the WBTC vault is because we are talking with institutions about Maker.
That makes sense. And yeah, a ton of institutions holding Bitcoin, so kind of a natural synergy there. Well, thanks for your response. In the meantime, we did have a question from Doctor here. Question for protocol engineering. Is there anything we can do to speed up the development of L2 solutions? And what are the primary time sinks involved with creating these?
Yeah, this one's that's a good question, Ryder. Time sinks. I don't know, Sam, if you want to jump in on this one as you're working with Chris on the development specifically. There's a lot of work here we're doing. We've mapped out our work into phases to kind of break it down. So we have the original, or we have the slow withdrawals followed by fast withdrawals, wormhole, and then getting into the MCD on L2 space. So it's a sequential work that's mapped out. But yeah, I see Sam's on if you want to jump into what some of those details refer to in more.
Yeah, I'm not sure how much more we can speed it up. Like, it's just smart contract development is just slow if you want to do it right. I mean, it's just a lot of thinking about things and like making sure it's correct and making yeah. So I mean, what could maybe help is more developers. Like, we've got so much on our plate all around, not even just on L2, like doing like compound D3M and the weekly spells and all this kind of stuff. There's just a lot of work. So I would say more developers could probably speed this up. But yeah, the bottleneck is just in general, the smart contract development. It's just a slow process everywhere.
Yeah, I think we're going around it the right way, though. We've got our focus of, like I said, this phasing, Sam, that you and Chris have been a major part of, breaking it down into its constituent parts. We're also looking at scaling the team, so having 2 more smart contract developers join us. One of those potentially more of a Scrum Master type organizational coordinating engineer type of role, because we do have a lot of discussions that are happening, not only in terms of what we're working on now, but also, East Denver was a great example where we had, Aztec and ZK Sync step up and say, hey guys, what about us? We're coming down the line. And we're like, okay, this is great. There's going to be liquidity in this space from discussions that we're having. So how do we make sure that we're in there from day one, as opposed to Arbitrum, where we were a bit slower to get on board, and we see the results of that now. So it's important to have those conversations, have the resources to be able to participate in them, and I think we're structuring in the right way to have the organization around prioritizing of these. So we have our weekly calls. We all have an understanding of where the cross-team dependencies lie. We're working really good with oracles, making sure that they are bringing in the touch points for the test net that we've got deployed at the moment, and making sure we can scale that as we go. So, so looking at the questions, are there competitors that are moving faster? Do we know what they do differently? I'm not seeing competitors that are trying to do the same thing as we are in terms of having canonical DAI. So of course, USDC is out there, but from what we're trying to do and really have an ecosystem that extends beyond any one single domain, I'm not seeing anyone doing that to the extent we are across optimistic rollups and ZK rollups. So looking at the Cairo code as an example and extending what we have into that domain as well. I'm not seeing anyone else doing that to the level we are. I don't know, Sam, if you've seen anything comparable.
What do you mean by competitors? Talk about direct competitors? Because, I mean, who would that be?
Maybe I can add something here. Like if you like, I don't think we can compare ourselves with others, because Maker, like, if you could say, okay, Maker is almost, it works kind of similar as, for example, Mai, but Mai, they are like a small protocol compared to Maker. Like, their use cases are different. It's not DAI. DAI is like the biggest decentralized stablecoin, and we are super conservative, and we are like the most secure protocol, and that is why we have institutions opening vaults. Like Mai, they are not after institutions; they are more after the DeFi space. So that is why they can grow faster, and they are deploying in other domains. You could also think about USD, who are growing with an impressive velocity, but also like the same thing, like their approach is different because they are not deploying the protocol in other domains. What they are doing is just they are working with market makers to have like the wrap version of their token in different chains. That is another approach, but we choose like the more puristic approach, and that takes time.
Thanks for fielding those questions and responding to the chat. Noting we have about 10 minutes left here from what we had allocated for this call. If you have other questions or comments, it would be a good time to start thinking about presenting them.
I see one question I don't think we answered was from paper. So if money was no object, could PE go faster on multiple fronts, or is sourcing devs the constraint? Sourcing devs is definitely a challenge. Sourcing the right devs is a challenge. Could we go faster if we had those devs? I don't see it as a solution being to find 10 devs and just say, go build. It's like Sam was alluding to, there's a lot of discussion, particularly on the MCD on L2 front, where we have to look, understand, assess the existing modules, break them down, understand where they need to be changed, modified, upgraded. We need to look at the overall system and upgrade the compiler version of it to be applicable in different domains. So there's a lot of architectural thought that has to go into this, and to do so really requires a solid understanding of the existing infrastructure on L1, which takes a bit of time. It's not something you can just throw anyone into the deep end on. So yeah, there's some constraints there, but gradual increasing of the team size is what I'm trying to target. So like I said, that 1 or 2 people growth gives people the time and ability to scale up gradually. So that's sort of the angle we're taking to be able to support these new L2s that are coming up, and that's the angle. So yeah, hopefully that answers your question there.
Yeah, one thing I want to add to that. So when I was saying more devs would help, I'm referring to sort of parallel efforts. I think we're nearly at full speed for any individual effort we're focused on right now, such as the L2 stuff. Like, we're going very fast. And we could maybe get marginal gains with more devs on a particular task, but more I'm referring to more things in parallel kind of thing. Like, there's all these chains coming up and stuff like that, and we just don't have the bandwidth to focus on all of them. So that's where more devs could help.
Frank, question for TJ for Real World Finance. Looking for an update on SocGen, and if SocGen got delayed, like who else might be our first institutional player if for whatever reason that deal were to fall through?
Sure. So we had a recent setback on SocGen on their end. Most of the things are sorted out. They're having to deal with a particular aspect of the DAI conversion, and their partner on that deal can no longer be used for reasons I can't discuss. So they're trying to onboard a new partner, and as you can imagine, a counterparty like SocGen needs to go through KYC, AML. But things look pretty good there. The ball's in their court, and assuming they can sort that out, that should be done fairly shortly. My guess is SocGen is in fact the first institutional deal we get done. We are working on a structured MIP6 that should hit the forum soon with another regulated entity, but that'll sort of be the beginning of that process. So summary, SocGen's court, SocGen should be the first institutional deal done.
Awesome, thanks, TJ. Makerman is asking about PE's kind of team growth, I guess. Asking kind of how many people you're trying to grow to, and if that's for the next year. Yeah, I think that's how I understood the question. Correct me if I'm wrong. Derek just typed it out, of course. Sorry.
No. That my response was to paper. His
okay.
question was so more SNE, so more Starkware type core units. As a question, I think yes, the more Starkware type L2 core units is definitely something we should look at. Again, in terms of scaling, I think the idea is here that you need to have a repeatable process in framework. And I referenced D3M. I think that's a great example. Like, have that bolted down, understood, have it formally verified, have audits in place so that you can show another team and give them something that they can then run with, own it, scale it, and be independent. I think this, getting back to the decentralized nature of having other individual teams own these things and being able to go forward is important. I don't see L2 as being any different. Now, to MakerMan's question, how do we feel on budget? Sounds like we want to grow 2 heads. Yes, that is correct. I think we're actually looking at 3 heads in total. This is to support the initiative around L2, 2 heads for L2 and 1 for core, based on the work streams that we've mapped out in the recent forum post. That's correct. This is for the next 12 months. I've also put a line item in the budget that if we're not able to get that individual, then those funds would be returned. So we're not looking to hold on to that, and that would be a quarterly change. So yes, that's for 12 months is the idea there. But happy to hear input from other core units, other delegates in terms of the size and the direction that we've mapped out in the MIP and the supporting documents posted in the last couple of days, as that's going into the April governance process. One final question I hear, or not final, but another question from MakerMan. I wonder where DECO sits here in terms of smart contract manpower. Do they fill this role, or are they completely separate? DECO is great because they have Vamsi, who really understands the Maker ecosystem. He's worked with us before. They are separate or independent, I would say, because they're working on the specific DECO protocol. It has some overlaps with the work we do because it integrates with DSS Gate. I mentioned DSS Gate earlier. That is a capability that will allow us to essentially create a sandbox so that we can have multiple initiatives be onboarded within a known debt ceiling, a risk limit. So this is important because it will help facilitate some of the work SES is doing in terms of looking to bring on other teams and a risk limit their engagement in terms of new modules brought into the ecosystem. So yes, DECO is separate in terms of working on their own independent module, fixed rate loan capability. But they do have great smart contract skills and experience, and we are working with them both in terms of a review and audit capability, and also a risk assessment, technical assessment as they get onboarded into the platform.
Thanks, Derek. And what might be a good wrapping up question if there's not else, but if you do have one more question, please throw it up so we can get it asked. There's been a lot of focus in the forum lately about expenses. I was wondering, probably fit for strategic finance, but other facilitators might want to weigh in. Is there like a good way to view like what a healthy expense is? Like obviously more profit is better, but how do we know how we're doing in terms of charting expenses versus the revenue expectations you laid out?
Yeah, I think this broadly goes back to something we're missing today, which is performance evaluation, right? Because without that perspective, it's difficult, in my view, to increase budgets anywhere without significant discussion back and forth. So I think until there's a more formal process in place, I think broadly maker holders should be quite judicious about approving higher spend, especially if the value delivered is not clear. I think there's some teams that have been with the DAO for a while or have proven their value, and obviously I would support budget increases in those cases. In other areas, it's not so clear. This also comes up with new core units being onboarded as well. So I think we've seen how quickly the market can turn and put pressure on rates. as well as force our borrowers to start unwinding some of their vaults. So both of those happen continuously, and you can kind of see the month-over-month impact of that in our latest financial report. It's a compounding effect. So even though our revenue run rate that's recurring today is around 75 million a year, that could quickly drop 10, 20, 30+%, even more if we're into a full-fledged bear market. So I think, it would be good for us to be conservative until the time where we have more in the surplus buffer, which I think people are looking into. But yeah, I think, it's a good time to be conservative given the geopolitical impacts that I think are spilling over into the financial markets. Makerman?
So my question's related to this, and it kind of comes back to Pico, right? Kind of in a pinch, could you and Deco kind of do more with less? I have this thinking in my head of like, we may have to slightly accordion in and out, as revenues flow. And I'm coming up with this question: if I have to come back to a unit and go, what can you give me at 80% funding, right? And so it's why I'm kind of less wanting to. I really want to grow. I want to have the money to grow, honestly, but in the face of not having that, I want to be able to have a good mechanic for pulling back, that we're not just cutthroating people and that we need. And you know what I'm saying? I'm like trying to figure out how to manage this in a way that we have some control over budget on the backside of this in governance.
Yeah, I understand. So you're trying to see what, if we do not scale to the requested amount, what do we lose by going to 80% of that? So yeah, I mean, we could do a better job of mapping that out. I've tried to illustrate what those roles would deliver and why we as a team have discussed them as being valuable. We could certainly map that out in greater detail and give you a more timeline orientated view of what delivery looks like, if that would help. I don't think there's much to align on with the Deco group beyond the work they're doing, as their mandate is pretty specific to what they're delivering, unless there was something else that they would want to do outside of that. But that's probably something for them to come up with or sync up with us on. So yeah, I can certainly take a look at how I will present core unit scaling in a more detailed manner. But that's something I'll have to think about. And I'll hand it over to Wouter. I see you've got your hand up.
Just to add real quick for Makerman's comment, this is a very standardized process in corporate finance and an annual budget process. Every function, I think in most Fortune 500s, I would suspect, are required to have basically contingency planning. Like if the market they're in goes into, bear market, we go into a broader recession, there's basically tiers that you're supposed to break out in your budget. Like, what are the first things to go if we need to cut costs? And then they go up the more, our revenue and profit goes down. So I think this is something we'd like to include in a revised MIP 40. I've mentioned on the forums in Du's thread about, I think, being more judicious about budgets, but I think we've just outgrown the MIP 40 as it stands today, and it can add a lot of value if we put more structure around it. But yeah, that's how I think about it now.
Thanks. Wouter, you got something?
Yeah, yes, stole my thunder, because I was basically going to say the same thing. But the thing I wanted to add is that there's a very big difference between the different core units in terms of what they can do. If you have a team of full-time contributors and that's the only thing you do, then obviously it's going to be painful to scale it back. But there are other core units, and SES is one of the prominent ones there, that have much more possibilities of scaling back, because there are the grants programs, there's the incubation program, etc. And that's another weak point of the budgeting methodology right now is that every core unit, they have their own contingency plans, and the budget caps, it's not budgeting, it's really like budget capping, because there is already budgeted in many cases for growing the team and eventualities. And really, when you create a new budget for a core unit, you have to kind of think, with 80% likelihood, what budget may I need on a quarterly basis? It might be that, or even monthly basis, it might be that it's very unlikely that you need it 4 quarters in a row, but you may need it 1 quarter or maybe 2. And that's another thing. So I think we can be much more specific, and that's why I'm less pessimistic in a way, because there are probably parts of the budget that can actually be shared between the core units, because, for example, if you were to have like a central budget that can be used as a shared contingency buffer or something like that, then you can remove that from the budget caps. The budget caps are sometimes much higher than the average actuals, because of these kind of dynamics. And you can easily see it, of course, if you look at the actual numbers versus the budgeted numbers. For SES, for example, the actual numbers are much lower than the budgeted numbers, because we need that ability to scale up and down. But that also means that you do have the ability to scale down if needed. And yeah, I think there are many more tricks that we can still look at to be more flexible in the budget that we deploy. But we haven't even begun this exercise yet. And so yeah, let's just start by asking core units if you would have to divide your budget up in these tiers. How much room for flexibility is there, and what is the time horizon, like the heads up that you need to scale up or down? We've never even asked the question. So yeah, that's the one thing like about the discussion that's going on. Sometimes we're jumping a little bit to conclusions, I think, before we've even asked the question, the relevant question. So let's do things in order and ask the question first, and then think about mitigation measures.
Thanks, Artur. Awesome. Obviously, we have gone on for a little bit here, as it is a pretty big topic, but really appreciate everyone being here and engaging. Any other last comments, questions, or concerns we'd like to voice?
All good here. Thanks everyone for joining their participation today, and we look forward to continuing to evolve this process.
Definitely a huge thanks to our presenters today. I'll give you a proper outro since I botched the intro. We had Mark and Seb from the Strategic Finance Core Unit, Nadia from Growth, we had Jan from Risk, TJ from Real World Finance, and Derek from Protocol Engineering. So thank you so much for presenting on those slides. Thank you everyone for asking questions. Let's keep any of the discussion going in the forum, and we'll see you around for the next one. Thanks.
Thank you.